Part 4 of SBR March 2020. So this is the last question, question 4. I'm not going to discuss question part A because part A is about sustainability, like why sustainability reporting is important for the investors. So you guys can go through that and you can understand, right? It's not that hard, so I'm not explaining it. I'm going to start from part B. So we are going to we'll go through the requirements. So the first one says that discuss how the 16 million provision associated with e-commerce companies moved to a new head office and the sublet of its old head office should be accounted for in accordance with IS 37. Now you see that this IS 37 is always repeated. Even in question 3 there was an IS 37, right? So IS 37 is a very important concept which is always repeated in the exam. Second is advise e-commerce on the principles of accounting for pension scheme, including calculations for the year to 30th September 2005. And finally, the last one, calculate the impact with the above adjustments. In part BI and B's second I will have on profit before tax of 25 million for the year ended 30th September 2005. Ignore any potential tax implications. The professional marks are here. So now I'm going to read through the case. The background, right? The directors of e-commerce company consider environmental, social, and governance issues to be extremely important in a wide range of areas, including new product development, reputation building, and overall corporate strategy. The company is taking a proactive approach to managing sustainability and is actively seeking opportunities to invest in sustainable projects and embed them in their business practices. The company's financial year end is 30th September 2005. So now we are going to the head office. E-commerce company is committed to a plan to move its head office to a building which has an energy efficient green roof that acts as a natural temperature controller. The move from the current head office, which is leased, will take place at the company's year end. The new green roof building requires less maintenance than a conventional building and produces oxygen, which offsets e-commerce company's emissions. The director of e-commerce believed that the green roof building will save the company 2 million per annum over the useful life of the building. Right? So it will save the company 2 million. However, over the next 2 years, it anticipates that the disruption of the move will cause the company to make a loss of 10 million per annum. The company wishes to make a provision of 16 million, which compromises the loss incurred over the next 2 years net of the saving created by the green roof. Now let's go. Meanwhile, the company will have to vacate its currently leased head office building at 30th September. The lease has 2 years to run at a rental of, say the lease has 2 years to run at a rental of 600,000 per annum payable in advance on 1st October each year. If the lease is cancelled, the full rental is payable on cancellation. The head lease permits subletting and e-commerce has sublet the building for 1 year from 1st October at a rental of 400,000 per annum payable in advance. E-com estimates that there's a 40% probability that it will be able to extend the sublease at the same rental for a second year. So that means there's a 40% probability that even in the second year they'll be able to sublet, right? And the cost of moving to a green building are estimated 1 million. Cost of moving is 1 million and the cost of terminating the lease in 2 years time are negligible. The pre-discount rate discount rate is 5%, right? So the pre-rate discount rate is 5%, pre-tax discount rate. About the pension thing we'll read later because we are right now answering the first part, right? So what we have to do is we have to discuss, right? They are planning to make a provision of 16 million. We have to discuss how it should be accounted in accordance with IS 37, right? So you have to be very thorough with your IS 37, right? It's a lengthy answer. So we'll see what they have to say. E-commerce company cannot make a provision of 16 million as the company cannot make a provision for the future operating losses. You should know about future operating losses, right? You cannot make a provision on future operating losses. This you should be knowing, of 20 million, right? They told that losses will be 20 million. This are specifically not allowed by IS 37. Nor take account of the saving 2 million, as no obligation exists. Even the savings of 2 million cannot be taken because no obligation exists. However, the lease represents what they have a lease agreement, right? What is that lease? The lease is an agreement. It's a contract, right? So the lease represents an onerous contract, yet and an appropriate provision should be made, right? On a lease contract, you can make an appropriate provision. So IS 37 defines an onerous contract as a contract. You have to define under IS 37 what this contract is defined as, right? So it is a contract in which the unavoidable cost of meeting the obligations under the contract exists, the economic benefits expected to be received under it. So your cost has to be greater than the benefit under the contract. And the cost has to be unavoidable. You cannot avoid something which cannot be avoidable. There are no explicit requirements for entities to search for onerous contracts, but it is implicit in its onerous contract principle that reasonable steps should be taken to identify them. If a contract is identified, right? If a contract is identified, a provision must be recognized for the best suitable estimate of unavoidable cost. IS 37 defines the unavoidable cost under a contract. So now we'll see what IS 37 defines unavoidable cost as. You need to define this, right? Whenever you talk about this, you need to talk about whenever lease is given under IS 37, you need to talk about onerous contract. You need to define what is unavoidable cost. All these are taken from the standards itself as it is, right? The knowledge part. So IS 37 defines unavoidable cost under a contract as the lease net cost of exceeding from the contract, which is lower of the cost of fulfilling it, and any compensation and any penalties arising from failure to fulfill it before a separate provision for a contract is recognized. An entity recognizes any impairment loss which has occurred on assets dedicated to that contract, right? So the onerous contract should be measured by determining the present value of unavoidable cost, net of expected benefits under the contract. The discount rate, which discount rate you should use? Pre-tax rate, which reflects the current market assessment of the time value of money and risk specific to the liability. All these are your knowledge part. They are taken as it is from the textbook. In this case, the requirement of the contract must be considered along with the prohibition in IS 37 of providing for future operating losses. Of future operating losses, you cannot recognize, but yes, for this type of contract, you can. It is important to distinguish between unavoidable cost under an onerous contract and a future operating losses. Future operating losses are not independent of the entity's future actions and do not normally stem from an obligation arising from a past event. A provision for onerous contract is recognized if the unavoidable cost of meeting the obligations under the contract or exceeding from it exceed the economic benefits expected to be received under it. That means your unavoidable cost has to be greater than the benefit under the contract. Then only you can recognize. In this case, it is. Now they have done the calculation part, right? So first, whenever you have to explain and calculate, always discuss first, always write the theory part first and then go and write the calculation part. It will be very easy for you to write the calculation, because whatever you are going to write in the calculation are explained, right? So first, therefore, the unavoidable cost should be discounted to 30th September 2005, right? How? 600 plus 600 divided by 1.05, because 5% is the pre-tax discount rate, right? And you have to take it for the 2 years. Why 2 years? Here, right? It is payable in advance, 600,000 per annum payable in advance on 1st October each year. That means for 30th September 2005 it will be paid in 2004. That you have to take into account. And the 30th September 2005, that means you have to take 2 years, but the first year's one will be discounted, will not be discounted, right? That's why it is 600,000 only. That means basically it's year 0 and then year 1, because you're receiving in advance. Same comes for the subletting part, right? So the cost is 600,000, the present value, right? This, and this is for 2 years because you are receiving 1 year before only in advance. So, and the other one will be divided by 1.05 because 5% is the pre-tax discount rate. And next part is the expected benefit, right? First one is unavoidable cost, and the next is when you sublet, you're receiving rent, it's a benefit, right? So the expected benefit of subletting the building arising will be 400,000, yes, and 40% into 400,000, because they told here the probability only 40% will be received as same as the first year, so which is 400,000. So 40% of 400,000, again this will be discounted by 5%, and then you take the difference between the cost and the benefit. A provision of that much can be made. In addition, a provision of 1 million can be made for the cost of moving to the new head office if it is felt that the cost is unavoidable, right? So there's a cost of 1 million of moving to the new head office if they feel that this is unavoidable, right? This can be added as a provision. So this gives a total provision. You add that 1 million with 619,048, you are getting 1.6 million, right? And this is the tutorial note. IFRS 16 says that the right of use asset at the date of the initial application is adjusted by the amount of any provision for onerous leases recognized in the statement of financial position. Now let's go to the second requirement. Okay, so the second requirement is asking advise Ecom on the principles of accounting for pension scheme, including calculations for the year to 30th September 2005. For that you need to read about pension. So the defined pension benefit pension scheme, right? Ecom is worried about poor remuneration package offered to employees is putting the company at risk of the reputational damage. Consequently, Ecom company changed its pension scheme to include all its staff, and the benefit required from the date of the employment but only vest after 2 years additional service from 30th September 2005, and the net pension obligation at 30th September 2005 is 78 million. This is this one, and has been updated to include this. During the year, benefits of 6 million were paid under the scheme, and Ecom contributed 10 million to the scheme. The payments has been recorded in the financial statements. So the net pension obligation at 30th September 2004 is 59. This is the opening, right? Service cost for the year 18. Past service cost 9. Discount rate of 5.5 for 2004 and 5.9. Now we have to know how to account it and calculate it. So first we'll be describing it, explaining it in theory, and then we'll do the calculation. Right? So let's see. At each financial year end, the plan assets and the defined benefit obligation are measured. Remeasurement gains and losses are recognized in other comprehensive income. This totally comes from your knowledge from your textbook. You should be knowing it, where the remeasurement gains and losses are recorded. The statement of profit or loss records the change in the surpluses or the deficit except for contribution to the plan and benefits paid by the plan and remeasurement gain and losses. The amount of the pensions expense to be recognized in P&L is comprised of service and net interest cost. So service cost will be there and net interest cost will be there in the P&L. Service costs are what? The current service cost, which is the increase in the present value of the defined benefit obligation resulting from employee service in the current period, and the past service cost. EMA company's past service costs are the changes in the present value of the defined benefit obligation for employee service in prior periods which has resulted from the plan amendment and should be recognized as an expense. IS 19, right? What comes here is IS 19 employee benefits. Requires all past service costs to be recognized as an expense at the earlier of the following dates. What are the two dates? A and B. When the plan amendment or curtailment occurs, or when the entity recognizes related restructuring cost or termination benefits. So which of this is the early? or that day, it will be recognized as an expense, the past service cost. So for past service cost, you need to know the method. You need to know this too, right? Then let's go. This cost should be recognized regardless of vesting requirements. Thus, the past service cost of 9 million will be recognized at 30th September 2005. Right? So when we do the calculation, now it will be very easy for you because you are saying that we will recognize it as an expense. Net interest on the net defined benefit liability is calculated how? By multiplying the opening net defined benefit liability by the discount rate at the start of the annual reporting period. Net interest of the net defined benefit liability can be viewed as effectively including theoretical interest income on plan assets. Right? The table below, you need to show in a table form because they told that calculation has to be there. So the table below reflects the change in net pension obligation for the period. The profit or loss will be charged with the net interest component of 3.2 million, right? And the service cost of 27 million. 18 is the current year service cost, 9 is past service cost. Add both, you will be getting 27 as the service cost. And net interest income is, net interest is 3.2. We'll see how. OCI, other comprehensive income, will be credited with 1.2 million, and this gain cannot be reclassified to profit or loss. Benefits paid have no effect on the net obligation as both plan assets and obligations are reduced by 6 million. Now we'll see, right? You need to know this. You need to know this calculation. First, we always start with the opening balance, the net pension obligation. At 30th September 2004, it was given as 59. Then on that 59, we take the 5.5%, not 5.9%. The 2004's rate is 5.5%. On that rate itself, we take 5.5% and get 3.2. And that 3.2 will go to P&L, the net interest component, right? And the service cost for the year is 18, past year is 9. Both the service costs will go to P&L, right? You need to write here, charge to what, where will it go? Contribution was 10 million. Right? It was given in the case study that contribution is 10 million. This is already credited to cash, right? How can you say it's already credited to cash? Because here they have told this payment has been recorded in financial statements. This payment has been recorded in financial statements, that 10 million, okay, contributed 10 million. And the benefits of 6 million. So they have already told that the benefits paid have no effect on this thing, right? And the remeasurement. Remeasurement means your other comprehensive of what will go there. How much it changed by 1.2, the difference. Because at the end, finally, you have to get 78. This is given in your example, in your question, right? And finally, the third part, also your professional marks is here, right? Calculate the impact which the above adjustments, this adjustments and this adjustments have on this adjustment. Profit before tax has been given as 25 million. Ignore any potential tax implications. So it's very easy. You just have to use the answers for both of this, right? So the profit before tax 25 million will suffer as the profit available to the ordinary shareholders will be reduced by, right? First we'll go from by the first one. Onerous contract provision was 1.6 million something, right? We'll go up and I will show you. It was this much. This 1.619048. If you want, you can write the exact figure. You can round it up to 1.6 million, right? Net interest component is 3.2, which will be in the P&L, this 3.2. And finally 27, 18 and 19, you add this to, will go to P&L here, right? And it will be 31.8, right? So this 31.8 and 25, the profit before tax, just find the difference and you will get the loss. So it does a loss of 6.8 million and will now be reported. That's why they are saying the profit before tax will suffer because the profit will be reduced now because of the adjustments, right? and professional marks for clarity and quality of discussion. So that's it for this. This is the last part of SBR, right? So through this paper, you can understand that this IS 37, some standards, some IAS, some IFRS are very, very important. It keeps repeating, right? Just because you got IAS 37 in one question does not mean you cannot get in another question. So IAS 37 or IFRS 16, right? Some standards are always repeated. Even in the same paper, you will be seeing in 2 3 places the same standards has been given. So you need to be very, very comfortable with this, right? And my only advice for SBR students are go through all IFRS, go through all IAS, make a list of all IFRS and IAS and see whether you are able to guess which one is which one and what are the recognition criteria, how you measure it, how you report, right? You know each one. And when you study, don't try to put all the standards, don't try to study all the standards together on a single day, or don't try to study everything together too fast. It's not possible. Take time. Like, my advice is master one standard, finish all the questions under that standard so that you know that you have understood. Because when you solve questions, you know, you get a clarity, you know what are the type of question, what are the different ways I can get a question on this topic. For example, let's say I'm studying IS 37, so my focus is only on IS 37. I'm going to pick up questions from IS 37 and attempt all those. I'm not going to touch any other standards until I master IS 37. So that should be your goal. That's how you should proceed when you start SBR, right? I know it's too late because exams are coming. So this is, but of course, for the next exam, you can apply these techniques, right? So you should first calculate how many standards are there in total, how many IFRS are there in IAS, how many total are there, how many days you need to cover all the IAS and IFRS, right? It could be maybe two IFRS one day, or one is too less, right? Two or three in one day. So you can go like, you can plan your schedule like that. How many IFRS, how many IAS I'm going to study today. Don't study by chapter wise. For SBR, study by the standard wise, your IAS, IFRS, right? Because what happens is, in a chapter there may be so many IFRS and IAS, right? Chapters are very small, but when you calculate your IAS and IFRS, I think around 46 to 44 total combined IAS and IFRS, if you combine the standards, are there around 46. I don't remember now. I calculated it when I was doing, so I had a number. I think it was around 46 or 48. I forgot now. Something around that range it was. So that's how you should plan your time, right? That I'm going to study this standard and all, rather than jumping from one standard to another standard, right? Trying to memorize all the standard in one day, you know. Better you master one standard so that later you don't have to come again and study it again, right? You can just revise and go. So that's a very useful technique, I would say, for SBR. And other than that, SBR does not have so much, it does not require so much of other techniques, right? Because so far SBR is the easiest paper in the professional level, the in terms of the mark and the pass rate. SBR is the easiest paper, so you don't need to worry about it, hopefully, right? You just, the only thing you need to is you have to be very good in your IAS and IFRS rules. You need to master it, that's it. So it requires a memorization also, right? It needs your memory power also, so your memory power has to be very strong. So you have to keep practicing it. Other than that, there are no other tips I want to give for SBR. As related to SBR, I don't want to give any tips. That's all. And best of luck